Hi, everyone. We would now like to talk about the different elements within the financial statements and how are these measured. For example, what are the available measurement criteria, which is present, through the framework. That's what we want to talk about, right? Now, essentially, when I look at the elements, we are primarily talking about assets, liabilities. So sorry, we're talking about assets, liabilities, and equity, for example. So it says that an asset is basically a resource controlled and it is expected to offer future economic benefits. Similarly, a liability would be a present obligation, which is expected to result in, again, outflow of resources. And similarly, when you look at equity, it is nothing else but the balancing figure, the assets minus liabilities, the residual interest in the assets of the entity after deducting the liabilities, right? What we would remember that a balance sheet, for example, is prepared at a point in time, right? So at any point in time, when you're looking at a balance sheet, what are those assets and what is the excess of those assets over the liabilities would be a representation of the equity, right? Now, while Ind AS 1 talks about it, right? What are the different categories of assets? But I might want to just segregate that broadly on the terms of something which is long-term assets, right? For example, I want to use the word non-current assets, right? And then the short-term assets, which are current assets, right? Now, these could be tangible, these could be intangible, these could be financial assets, these could be non-financial assets and stuff like that. So that's where we start talking about the examples. Now, but no matter the categorization of, let's say, an asset, we are talking about those aspects or the attributes of having control plus expectation of future benefits, right? That has to be always present. Otherwise, it cannot be an asset in its context. The simplest example I can think of is if I say that company X is selling goods to company Y on credit, but for example, if it knows at the time of sale that the money is not recoverable, right? Essentially, you don't have a flexibility or a freedom to show a receivable in the books, right? On paper, the invoicing is done. On paper, there's a receivable, but collectability is the question because the company Y is as good as a bad debt. So you cannot call it a receivable because those benefits are not available. You can't just claim those, and accordingly, the value of the receivable has to be nil, no matter, let's say, you're selling it for 10 crore rupees, for example, right? Similarly, when you look at the word control, you talk about this perspective that even if you legally own an asset, right, or you don't own an asset but you have a control over that, normally in a lease arrangement, you would see those parameters getting met, right? When you have a right to operate the asset, etc., then you start using the word control in that context, and accordingly those assets would be recognized because both those attributes of control as well as expected future benefits are being met in the definition, and accordingly you shall recognize those in that spirit. The same way we talk about liabilities, where we say that one is there is a present obligation, and the other part is, of course, you look at expected future outflow, right? Any any loan that you have taken, any payment to the suppliers, any warranty provisions, etc., they all meet these attributes of present obligation as well as the expected future outflow. So tax provision, for example, right? So in a way, when I'm referring to the word liabilities, all I'm trying to say is that there is no way you can avoid it. It does not seem to be available. That option of avoidance of the payment, for example, is not available with the entity, and that's the reason why the word liability, because the entity is liable, the word liability comes into the picture in that context, right? So these are all the definitions which play a role. And as I said that, when you deal with the accounting, right, be it at the examination level or even in practical life, it could be a very relevant area. The conceptual framework could be a very relevant area for you to take a judgment about it, whether something is to be considered as an asset or a liability, right? You would recollect when we originally started the discussion, the introductory part of this area, we talked about even a contract of hedging could be an example of an asset. So interestingly, the same contract can also turn into a liability in future. So you need to be looking at those broader definitions, right? There's an outflow, and it can be measured reliably, and of course there's a present obligation. Similarly, on the asset side, there's a benefit and the cost can be measured. So they're all becoming a part of the discussion here. So I need to be carefully assessing those at any point in time. Similarly, when you look at the broader elements within the P&L's perspective, we talk about the incomes and expenses, right? The difference between the two is, of course, profit, right? So when I say I'm looking at income, we're talking about what is the overall increase in the economic benefit, but the expenses would be a reduction in these economic benefits, right? So that's where you start looking at the definition of income per se, right? If I simply say that I purchase goods for 100, but I sold them for 120, effectively 20 is the benefit. That's what you're getting, either in form of cash, if it were a cash sale, or even if it were a credit sale, then I know that there is an increase in my receivable. Okay, so you start bringing that net impact of the transaction, of that business transaction, and see to it whether it results in the net increase in the economic benefit to the entity, right? It's a very simple definition, so I don't expect the examiner to be really bothering us a lot about that, but at the same time we should be knowing about it, right? The recognition criteria is a broader definition. In case of an income, we say that you would recognize that only if the benefit can be measured reliably. It would be recognized, for example, there would be an increase in asset or a decrease in liability, and just vice versa for the expenses, right? So when the decrease can be reliably measured, and of course there would be, let's say, you talk about increase in liability or decrease in the value of an asset, right? Something that you want to kind of consider. Importantly, transactions with the shareholders excluded. What does it mean? It means that, for example, a dividend payment is essentially a payout to the shareholder, right? And when you pay something, of course, your assets, which is cash, they get reduced. So is it an expense? Probably no, right? But then you don't want to call it an expense either, right? It's purely a transaction with the shareholders in their capacity as an owner, right? Likewise, if there is, for example, shares issued to the shareholders, right? There could be a capital raised. This would result into increase in cash, right? But does that increase in cash become an income? Again, the answer is no, because you're doing the transactions with the shareholders in their capacity as shareholder only. So any such kind of transactions would not change your profitability, would not result into any income or expenses per se. Okay, that's the broader understanding that we want to bring along. Okay, now this is the last section on the measurement part of it. We have heard of these concepts as we were discussing in the initial discussion of the introductory part. We talk about historical cost and the market value, which is the fair value also. And also we have read about this net realizable value in the context of, let's say, inventories in AS2. But the Ind AS also bring now very commonly, the aspects of something called as a present value concept. Okay, so there could be a very long-term commitment that I would have done, right? So if I'm supposed to pay for that, I can't wait for the date when this payment would be made. So I need to make a provision for that today. But recognizing that full provision which I'm going to pay, let's say after 20 years, is again not appropriate. That is where the discounted value or the present value comes into the picture, right? Historical cost. If I really go back on this, historical cost is simply, let's say in case of commonly used in case of physical assets or intangible assets also, right? So start looking at whatever is the amount that you're supposed to pay to acquire an asset becomes the historical cost. So use that as a basis. But sometimes you might be using, a revalued amount also. So there are different discussions that would happen across different standards, right? And interestingly, importantly, some aspects are very clearly defined. So Ind AS 13, Ind AS 113, sorry, defines what is a fair value. While the definition is given here, it is covered through Ind AS 113. Now the framework is giving you the guidance that yes, fair value is permissible. Okay. Similarly, net reservable value is covered through Ind AS 2, which is inventories. It talks about what is that recoverable amount or what is the net realizable amount. The present value is not necessarily covered through a standard directive, but it talks about the discounted value of the cash inflows or outflows. We are required to look at this present value concept in application of different areas, right? That's what we want to kind of look at eventually when we discuss those standards, right? Common examples I think we can talk about here quickly is historical cost could be very common for physical assets, for intangible assets as well. Fair value could be commonly used for investment made in shares of another company, right? We'll see when we discuss the specific standards. Net realizable value, common example is of course inventories. The present value could be a long-term liability, a long-term provision that I need to that I need to showcase in my books. And that's the reason why the present value concept would be relevant there. Okay. Just to revisit, it's a small section that we talked about that you would have these elements of financial statements. We talk about, of course, assets or liabilities, you talk about equity, you talk about income and expenses, and the basis of measurement would be historical cost, fair value or the current value, then net realizable value, and of course, the present value. All right.